Thank you, David and the panel, for this interesting session. We now come to our next session, which is moderated by Mr. Safdar Jaffer, and the paper will be by Mr. John Gilbert. It has an interesting title to the paper, but I leave that to Safdar Bhai to manage. Please, Safdar.
Thank you very much. Good morning and salamun alaikum to everybody. If we can have the presentation there, perfect. Iqbal, as you know, being one of the pioneers of the think tank behind the ideals of Takaful, I distinctly recall it was the 5th International Takaful Summit, where he asked me to present a paper on mutuals and Takaful. This is going back 8 years. This was the master class that we had. And at that point in time, Milliman produced the first ever family Takaful report. And within that report, we had a special feature on UK mutuals and Takaful. It is at that point in time, 8 years ago, that I had the privilege of working with John, who has devoted or dedicated his life and has worked with mutuals in the past and probably continues to do so. What's interesting is that 8 years have evolved, or 13 years from the day ITS started, and we haven't really seen anything substantive when it comes to mutuals and Takaful, but Iqbal always ensures that these forums have the ideals that continue to be talked about, although in the real world in which I live, the commercial world, it's not still feasible, or put it that way, it hasn't manifested. But having said that, it is important to keep the ideals, and John has been one of those who has continued to provide that input to us. But before I call him, just to remind the audience and some of you who may not be familiar to the correlation between mutuals and Takaful, I just extracted a few notes from that report. And I thought I'll share with you, remind myself and yourselves about the context of this discussion, and then I'll get John to come on board. Unlike proprietary companies, mutuals are owned by their members. But like Takaful companies, both operate on the principles of mutual guarantee, and any surpluses that emerge go back to the participants. So this is where there is that point of commonality. Now, even in UK, mutuals are struggling. I'll probably leave that to John. But from that report, at that point in time, we were talking of the aggregate of over 90 billion as far as the UK provisions for mutuals were concerned. And 1 in 3 British residents had some form of connection with mutual companies or members of different mutual funds. I don't know what is the story today, but I'll leave that to John again. The other thing about mutuals is that there are no shareholders. So it is exclusively a mutual club or a members who get together and in solidarity with each other work together, and they may devolve the risk of insurance, but ensure that everything is shared within that spectrum. Whereas in Takaful, it's a hybrid model. So you have the pool that is put together where all the policyholders come on board, but at the same time you have the wakil who manages the pool. So it's a kind of a hybrid, and the wakil is expecting profits out of either wakala fees or some form of incentives to have managed the pool effectively and efficiently. So the models do vary. So having said that, I probably won't spend more time on these. Suffice to say that one key point in that report, going back, where we spent quite a bit of time in trying to understand the marriage or the potential marriage between the two, was surplus sharing. because the surplus sharing within with-profit funds and mutuals is profound. As an actuary, the first thing that I look into when I look into surplus distribution is, does it meet policyholders' reasonable expectations, yes or no? And this is a good starting point. UK has a profound history of managing with-profit funds, ensuring fairness, ensuring intergenerational surpluses are managed effectively. You may have a rainy day in one year and a good year. How do you smoothen those surpluses over time and ensure that the members benefit? This was one key area that came out, and we thought we should probably explore that. And our conclusion in that report was that if there is something to be learned out of this, probably this is one key area that we need to look into. So really, without further ado, it's over to John, and the theme is empathy between mutuals and Takaful. Can we make the marriage work?
Well, thank you very much indeed for that introduction. I remember very well that those early conferences where we spoke about mutuality and the synergies between mutuals and Takaful. Let me move on to now. I'm standing here with some embarrassment this morning because I realized it was one of those sinking in the pit of the stomach moments that I had sent the wrong set of slides to Iqbal. So the good news for you is that you're not going to be subjected to death by PowerPoint from my slides today, because they're slides that I prepared for last year's conference when I spoke on a similar subject. But I'm not going to bore you with repeating what I said last time. I think that analogy between the relationship between mutuals and Takaful and that of marriage is a good one. Last year, I made, I think, the mistake of pushing the analogy a bit too hard. What I did was I looked through some Lonely Hearts columns in the backs of newspapers and took some of the things that people who were looking for marriage partners were saying about themselves, and tried to draw an analogy between that and mutuals. That didn't work for two reasons. One, I think it fell rather flat when I tried to present it. But secondly, and more importantly, my wife saw me doing it, and that put my own marriage under a temporary strain. So we won't go there again. But I think there is some real value in that analogy, in as much as if you have to try too hard to make a marriage work, then there's probably something wrong with it. But even in the best marriages, there is a need to work at it sometimes, however much there is each partner making an equal contribution, however much compatibility there is. And I think there is a lot of compatibility between the ideas of Takaful and the basis on which mutual insurers work. So let me give you a very brief rundown of the history of mutual insurance in this country. The very earliest traceable mutuals actually go back to Roman times, but in modern form existed in the Middle Ages. But it really came into its own in the 17th and 18th centuries, when the old fire companies were formed, which were mutual groupings of property owners who came together. They had their own private fire brigades, and they put on the walls of the buildings that they owned that were in the insurance grouping in that mutual bond a little plaque to say that they were insured by the company, they were members of the mutual. And if there was a fire, then the private fire engine would come, would see whether the plaque was there. If it was, it would put the fire out. If it wasn't, unfortunately, it would allow the building to burn down, which isn't a terribly auspicious start to mutuality. But the idea grew, and particularly in the life sector, many of the early insurance companies were formed as mutuals. Right at the beginning of the 18th century, Amicable was formed in 1702, and then throughout the 1700s, other companies were formed. But the idea really took root and took off during the Industrial Revolution, when there was a big movement from the countryside into the cities, and people were displaced from the social networks which provided a degree of insurance for them, looking after them in their old age, and grouped together to set up the earliest friendly societies, which started off just by taking a few pence a week in premiums and putting them towards the cost of a funeral. And then that expanded into life insurance as we know it today, and also a degree of sickness insurance. And then into the 20th century, when the UK first began to evolve a welfare state, the mutual insurers, the friendly societies, were very much part of it, that people were encouraged to pay premiums into mutual insurers under the First National Insurance Act, which was way back in 1911, in order to cover medical costs. And then that was all nationalised with the National Health Service in the late 1940s. There was a bit of a decline in the last half of the 20th century, as has already been alluded to. And that was driven, particularly in the 1990s, by a move of demutualizations, where people saw that mutuals had accumulated strong capital reserves and wanted basically to get their hands on them, and that saw the decline and the death of many mutual insurers. But they have proved their worth, those that have survived that period, and there are many, particularly during the financial crisis of 2007-2008, when mutuals, because of their ethos, were able to take a longer-term view, were not driven by quick profits for shareholders, had a stronger, more resilient capital base, and survived the financial crisis much better than many conventional companies. And I've mentioned friendly societies. Of course, there were many mutual insurance companies limited by guarantee. Some of you who are UK-based may be aware that the very largest UK friendly society, Liverpool Victoria, this year voted to cease to become a friendly society. But what is encouraging is that it is remaining a mutual. It is changing from its friendly society status, which involves a number of restrictions on what it could do, into a company limited by guarantee, and thus still a mutual. My own involvement with mutuals is rather serendipitous, as careers often tend to be. I'm a solicitor by trade, and when I was a trainee solicitor, they called them article clerks in those days, I was very interested in a career in banking law, which indeed I followed. But as an article clerk, I did a stint in articles with a tax specialist who had set up a friendly society to provide in-house private medical insurance for junior staff at one of the national banks. He then moved to one of our overseas offices. I'm not quite sure to this day what my firm was doing, sending a UK tax lawyer to an overseas office, but it was a great break for me because I looked after this client. And then in 1992, when there was legislation in the UK which really brought, rather late, the friendly society movement into the 20th century, just as the 20th century was ending. I was able to advise this client, did some work on getting familiar with the 1992 Friendly Societies Act, and on the back of that advised a number of other societies and built up, if it's not too immodest to say so, a bit of a reputation of expertise in this very narrow area. And then one of my partners introduced me to Iqbal, and that was one of those sort of wow moments that one has in one's career, because I realized that as he talked about Takaful and as I talked about mutual insurance, we were actually talking about something that was two things that were very compatible with each other and had similar objectives and similar methodology. So the nature of a mutual insurer, Iqbal in his opening comments spoke about the root of coming together in Kaful, in the word Takaful, and that's very much what a mutual insurer is about. As we've heard, the policyholders are the people who own the business, and very often, in fact almost invariably, that's on the basis of equality among policyholders, regardless of whether you have a large policy or a small policy, whether you've been a member for a long time or a short time. It's all on the basis of one member, one vote, one policyholder, one vote. And that, I think, is quite a well-recognised model. It has a 300-year history in this country, but replicated elsewhere as well. Here, mutual insurers can either be friendly societies or companies limited by guarantee. And outside of the insurance sector, of course, mutuality is also a well-recognised model. You have, in the banking sector, you have building societies, which are all mutuals. You have also credit unions, which are on a mutual basis, and there's been a lot of interest in them recently as an ethical alternative to banks, and particularly to payday lenders. So what are the advantages of mutuality when it comes to a channel through which to promote Sharia compliant insurance? The first one is simplicity. This is a very simple model, and early in my work with Takaful, I came across writings by an Egyptian academic who now works in the US by the name of Mahmoud El-Gamal, and he's based at Rice University. And I read a paper he had published with the wonderful title, Mutuality as an Antidote to Rent-Seeking Sharia Arbitrage in Islamic Finance. Despite the title, that's quite a readable little article. And his main point is that rather than setting up a very complicated structure, mutuality actually presses all the buttons that need to be pressed in terms of Sharia compliance, and does so in a much more simple and more transparent manner. Another advantage of that simplicity, of course, is that the regulators, in Europe in particular, have been clamping down on complex products. There's been, in the European Union, something called the Insurance Distribution Directive, which has been implemented in the last year in the UK, which makes it much more difficult to sell and imposes additional obligations on those who seek to sell complex products. So simplicity is a good thing from a regulatory point of view. As I said earlier, in relation to the survival of the financial crisis in 2007-8, the lack of shareholders, the lack of the need to make a quick profit has allowed the mutuals to take a longer-term view and provided policyholder security through greater resilience. And then there's also the question of timing. In order to, if you want to introduce a Takaful product, there are many